The top 5 short-term income-generating investments.
There is no one-size-fits-all approach to investing. Rather, the foundation of portfolio creation is matching your financial decisions to your specific goals and time horizon. For example, you would typically favor long-term growth if you were investing for retirement and had several decades to go. This frequently entails putting a sizable amount of your portfolio into riskier but more lucrative investments like equities, which have the potential to yield substantial returns over time. You may take advantage of the compounding effect and weather market turbulence with a longer time frame. On the other hand, the investing environment changes if your ambitions are more imminent, such as saving for a down payment on a house within the next few years. Usually, the emphasis shifts from capital growth to capital preservation and income production in this kind of situation. Because there is a shorter recovery period from potential losses, risk appetite is typically more conservative. You are searching for stable, trustworthy investments that will yield modest returns rather than going all in. The idea is to maintain your immediate financial goals within reach by finding a balance between limiting risk and generating a return that outpaces inflation. Due to their low volatility, low interest rate risk, possibility for income, and liquidity, short-term investments may be useful in this situation. According to John Croak, head of active fixed income product management at Vanguard, these products are best suited for investors who are saving for a large expenditure, e.g., a down payment, college tuition, major purchase, etc., with a time horizon of roughly 1 to 3 years. To further minimize volatility and drawdowns, short-term investments might have a place in the portfolio of even long-term buy-and-hold investors. Short-term funds can also be a logical, first step, back into bonds for investors who may have abandoned a traditional fixed income strategy amidst the losses of 2022, says Croak. Experts rank the following 5 categories of short-term investments as the most effective for yielding income. 1. Treasury notes. 2. Deposit certificates. 3. Money market instruments. 4. Extremely short-term bond funds. 5. Bond ETFs with a target maturity. 1. Treasury notes. The United States government issues short-term debt securities known as Treasury bills, or T-bills. Buying a T-bill essentially amounts to lending money to the government. In exchange, the government promises to reimburse the entire bill's face value when it matures. One useful approach to conceptualize them would be as a 1-year or less maturity IOU from the government, typically maturing in 1 month, 3 months, 6 months, or a year. They stand for the lower end of the yield curve on Treasury securities. Further, sitting in her comfortable home office, a young woman uses computers. Idea of working remotely and as a freelancer from home. Caucasian woman dressed in household attire. The idea is to maintain your immediate financial goals within reach by finding a balance between limiting risk and generating a return that outpaces inflation. There is no one-size-fits-all approach to investing. Rather, the foundation of portfolio creation is matching your financial decisions to your specific goals and time horizon. It's not difficult to find a fiduciary financial advisor. You can find up to 3 local financial advisors in your area in 5 minutes with SmartAsset's free service. SmartAsset has thoroughly screened each advisor and holds them to a fiduciary standard, requiring them to behave in your best interests. Set out to accomplish your financial objectives. According to Thomas Samuelson, Chief Investment Officer at Vineyard Global Advisors, we think T-bills are the most attractive short-term investment for income right now, on a risk-adjusted basis. T-bills are among the safest investments available because of their short maturity and U.S. government backing. They also have low interest rate risk and credit risk.
Two. Deposit certificates.
According to Taylor Cover, CEO and founder of Cover Wealth Management, certificates of deposit, or CDs, are time deposits offered by banks with a fixed term, typically ranging from a few months to several years. They provide a guaranteed interest rate, making them a safe and predictable investment. Investors that buy CDs lock in a specific interest rate for the duration of the CD. The interest rate paid by the CD will not vary throughout this period, even if interest rates do. These instruments do, however, have a significant flaw. The trade-off is that your money is locked in for the term of the CD, adds Cover. Investors may be subject to an early withdrawal penalty if they cash in their CD before the maturity date. Investors that are successful with CDs should know exactly when they need to access their money. They're ideal for investors looking for a low-risk option and have a specific time horizon in mind, says Cover.
3. Funds for money markets.
One kind of mutual fund that makes investments in highly liquid short-term securities like treasury bills, commercial paper, and repurchase agreements is called a money market fund. Money market funds, which provide liquidity and security within a brokerage account, are frequently utilized as a cash equivalent to temporarily park funds. A money market fund's net asset value is designed to stay constant at $1 per share, which makes it simpler for investors to enter and exit the fund without losing their initial investment. 4. Funds for ultra-short-term bonds. Funds for ultra-short-term bonds invest in investment-grade fixed-income instruments with maturities of typically less than a year. These products seek to offer a lower risk profile in addition to a greater yield than money market funds. Ultra-short-term bond funds offer a medium ground for investors who want somewhat greater returns than a money market fund but aren't ready to take on the dangers of longer-term bonds. Ultra-short-term bonds do not, however, come without danger. While ultra-short-term bond funds generally provide a higher yield than money market funds, they are a bit more unsteady, explains Cover. According to Emily Kozad, portfolio manager, research analyst, and investment funds specialist at Buckingham Advisors, we believe money market funds are currently the best short-term investment to generate income as these kinds of funds generally invest in very short-term debt that is highly liquid, of higher quality, and with less associated risk. 5. ETFs for target maturity bonds. ETFs for defined maturity bonds, like Invesco's BulletShares and iShares iBonds, provide a special option for short-term investors who desire the stability of a maturity date along with the advantages of a diversified bond portfolio. Definable maturity bond ETFs comprise a portfolio of bonds that are all scheduled to mature within a given year, all the while paying out monthly interest, in contrast to most bond ETFs, which hold a constantly changing portfolio to maintain an overall target maturity range. The ETF matures, akin to a conventional bond when the designated year comes, at which point it distributes the value to investors and liquidates its holdings. This structure provides clarity on return and yield, making them suitable for investors with a specific timeframe in mind, explains Cover.
Check out most people favorite YouTube channel to watch the full video. Make sure to subscribe.